What's up, everybody? It is Thursday, September 9th. So, 4 days down in the market, 4 days down, all right? We may have a reserve problem, and by that I mean reserves in the banking system. This is the 10th week up. In the latest week, ending just yesterday, up another 54 billion. I believe we're at 4.26 trillion, a record. And in the last 10 weeks, up 750 billion. Now, you know, the Fed's been conducting these reverse repos. That's like right now, I think they're up to 1.4 trillion, but doesn't seem to be keeping pace with the growth in reserves. And I'm kind of concerned with that because, you know, we could see reserves hit a threshold. Again, you run into problems with the leverage ratio of the bank, supplemental leverage ratio. All of these reserve assets being added to bank balance sheets, that's not good. I mean, because at some level, they either have to increase their capital, and I've been talking about how the banks have been so resilient. I mean, I've been surprised by this. I've been impressed by this, that we have seen, in spite of this monumental reserve growth, we have seen loan growth happening at the same time. Now, it's been happening slowly, but it is growing, and that's impressive. And it says to me that the banks are well capitalized. But at this rate, I mean, you know, when you're going up 50 billion a week in reserves, it just doesn't seem now that the Fed's reverse repo operations are keeping pace. I mean, reserve growth is occurring faster than these reverse repos. So in other words, what are the reverse repos? It's a mechanism by which the Fed temporarily sweeps some of that cash off of the bank balance sheets, replaces it with treasuries, with the collateral that the banks need and want. And it's a temporary operation. Usually these things are a day or a few days. They have to be rolled over. And the Fed keeps raising the level of these reverse repos. In other words, I think it started out originally with like 500 billion. They said they were going to set up a facility of 500 billion. We're up to 1.4 trillion right now, and bank reserves are still growing. So what does this mean? I mean, it may mean nothing. Okay, we may just continue like this. Like I said, the banks seem well capitalized. They've been able to increase their lending despite this reserve growth. Or it may mean we get to some kind of threshold, some kind of level where the banks, you know, basically cry uncle. In other words, okay, that's it. I mean, we can't handle this anymore. What do they do in that case? It's not automatic that they run out to raise capital, but, you know, banks also hold portfolios of trading assets. Those could be derivative contracts, you know, they could be interest rate derivatives, they could be stock index derivatives, they could be Forex derivatives. They use those. That's kind of like ballast, right? They could sell those off. And I noticed in last week's banking report, that's the H8 release that comes out on Friday, there was a significant amount of selling in these trading assets. So we may see that continue. And if that does continue, I think it can put further pressure on the market. Now, interestingly, the flows, the fiscal flows look, I gotta say, really, really good. Like, I haven't seen any deceleration in the flows at all. And now, you know, we're a couple of days into or removed from the unemployment cuts. That's the supplemental unemployment insurance cuts. That's the $300 a week. Everybody was kicked off of that after Labor Day. Not only do I not see a slowdown in the fiscal flows, all right, I don't even see a slowdown in unemployment benefit flows. I mean, those things are actually going up. They're now at the highest level. If you look, I look at the 5-day average of those flows. It's at 1.4 billion. That is the highest level since July 14th. And it looks like those unemployment flows bottomed out. That 5-day average that I'm talking about, looks like that bottomed out in August. And it's been going up, which is weird because today's weekly claims for unemployment insurance, that was down to the lowest level in 18 months. So I don't see anything in the fiscal flows which makes me think that, you know, this correction that we're in right now is definitely going to present a buying opportunity. But I am concerned at the moment with reserve balance increases and what that may trigger in terms. I mean, we've seen this stuff in the past. In the pre-pandemic days, these reserve flows used to be really, really tradable. All right. And then there was that period in the pandemic when they suspended, they didn't suspend the leverage ratio, but they suspended the inclusion of reserve assets in the calculation of the leverage ratio. Remember, that ended last March, and everybody was saying, oh, you know, that's going to be terrible and that's going to create a crash and everything like that. But that didn't happen. The banks, you know, knew that was coming. They prepared for that with adequate levels of capitalization, and so it hasn't really been a problem. But if you go back before the pandemic, this was like a really tradable phenomenon. I mean, every time we saw these big swings in reserves, when they flowed onto bank balance sheets, we would get, you know, pretty significant stock market corrections. I'm talking about 10% or greater. I mean, that was like a regular thing. You go all the way back to 2018. I mean, I traded those. We traded those as, you know, my subscribers, and I was putting that out, you know, on a weekly basis. We would track those flows, and they were very, very tradable. I mean, we may be back in that paradigm right now once again. We may be back in that environment where, you know, if we reach a certain threshold of reserve balances where the banks are like, okay, that's it, Charlie, we got to sell right here in order to, you know, make some room on our balance sheet, then we're going to get these patterns of stock market sell-offs based on these flows. The other thing that could happen is that the Fed throws in the towel and says, all right, we got to stop buying assets every month because it's not doing us any good to be adding 120 billion a month in reserve assets when, you know, Treasury is still under the debt ceiling and can't sell any securities. You know, security sales are a reserve drain. They're a necessary function to, you know, keep the financial system healthy. All right, it's not borrowing. All right, it's a reserve drain. But Treasury can't do that now because it's under the debt ceiling. So, like, you have shut down a very important mechanism for keeping the whole financial system stable. That function of reserve drain, we just don't have it. And the Fed may be thinking, you know what? They may be finally realizing that this QE, these asset purchases, are just doing more harm than good. Now, if that were to happen, all right, if they came out and we got the meeting coming up September 22nd, right? That's the Fed meeting, and everybody's real worried about that. And there's a good possibility they're going to say, hey, we're going to announce taper, you know, maybe sooner rather than later. I don't know. But all they have to do is state they're going to do that, and everybody's going to go crazy. By the way, folks, if you go back and look at these central bank pronouncements, these central bank statements, policy statements, and I follow this and I track this, if you go back and look, and if you faded these moves, in other words, if you went against these moves nearly every single time, these reflexive knee-jerk moves triggered by whatever a central bank says, and I'm talking about, it could be the ECB, the two big ones really, ECB, the Fed. You could also do it with Bank of Canada. You could do it with Australian RBA and the New Zealand Central Bank. I mean, you make a lot of money. You go against these zombies. So I'm not so worried about that. I just think that something, out of left field could pop up, and we have to always keep that in mind. But right now, just as far as the flows are concerned, they're looking good. I don't see any deceleration even after the end of these unemployment payments. So yeah, let's see what happens. Anyway, don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial for MMT Trader. See you tomorrow. Bye.